So we don't have a target range for the krona exchange rate. It is floating freely. Our objective is to ensure inflation coming back to 2%, and our policy instrument is the key policy rate. But obviously, as a small open economy, the movements in the exchange rate matter for inflation, for imported inflation, and the fact that the krona has been weaker than projected in December is one of the reasons why we now think that there is a need to hike rates more in order to get inflation back to target.
So let's go with your base case scenario, which sees rates rise to 3.5% around the summer. How long do you expect rates to remain at that level, 3.5%?
Now, there is considerable uncertainty about the economic outlook and therefore also about the outlook for the interest rates. But the projection that we present today indicates that we need to have monetary policy in contractionary territory for some time. More specifically, that the interest rates could lie around 3.5% also through next year.
Let me ask you about the banking sector troubles that we've seen on both sides of the Atlantic over the last couple of weeks in the U.S. and in Switzerland in particular. How worrying has the turmoil in the banking sector been, in your view?
So obviously, it is a matter of concern when large banks in Europe and in the U.S. suffer a loss of confidence. Now, obviously, the authorities have implemented measures to limit the contagion to other institutions and markets. And we have seen fairly limited contagion to Norwegian banks' funding costs. We have no indications that Norwegian banks are facing liquidity problems. And in general, they are both profitable, well-capitalized, and well-positioned to cope with a period of market turmoil or larger losses. But obviously, as other central banks, we're monitoring developments closely.
All right, so no liquidity challenges of note in the Norwegian banking system as yet. What about lending conditions? Are you anticipating a tightening of lending conditions given the situation around the world?
In our baseline scenario, we're not assuming that we will see a significant tightening of credit or financial conditions, but obviously that's one of the reasons why there is considerable uncertainty about the outlook, and we will monitor that closely. And in the event that we see tightening, that could have implications for our forecasts for growth and inflation, and thereby also interest rates going forward.
Thinking about central banks more broadly, to what extent do you think the tightening that we're seeing around the world, from Norges Bank included, to what extent could that tightening amplify the economic downturn and increase those very risks that we're starting to see emerge in various banking sectors?
I think overall, and this is also our objective, we need to set policy rates and monetary policy in order to bring inflation back to target. And that is the way in which we can contribute best to achieving overall stability in the economy in the long run. But obviously, there is a balancing act, and that has also been part of the committee's discussion this time around. On the one side, the risk of tightening too little, risking that inflation becomes entrenched at a higher level. On the other hand, the risk of tightening too much and thereby causing a larger slowdown in the economy than necessary to curb inflation. So this is a balancing act, and we believe that with our current interest rate projection, we will get inflation back to target without significant costs in terms of high unemployment.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.